All right. Well, welcome to the first episode of Market Pulse. Look, at RW Paul, we're constantly working on new ideas and initiatives that bring you closer to the team looking after your hard-earned money. I think one of the founding principles of this team is to provide regular and proactive communication, not just about our investment process and what hot stocks we see and what we're worried about, but it's also where we see opportunity and risk on a broader scale. Bepin, when I got in this business at this point many years ago, decades ago, the challenge back then was getting access to information, right? And I worked for a firm, and we were gatekeepers for a lot of that information. I think if you fast forward to today, I think the real challenge is that you have to sift through a lot of garbage to find what really matters. The advent of technology, the speed at which stuff gets communicated, and the laws around requiring everybody to get the same information at the same time has made it a completely different world. So I think what we're trying to do here is to provide a quick 10-minute or less breakdown of what Bepin and I have found out there that we find to be interesting in terms of stories or information, but also in our daily communications, trying to figure out what we feel is important to share with our investors along the way. So with that, let's go ahead and get started. I think the title, Bepin, of this is absolutely applicable given where we are right now. Wake me up when September ends. And
Fantastic
that's
song.
what's going on. It's a great song from Green Day for those of you who have not heard it. It's actually a sad song, but nonetheless, I think the lyrics of this song they directly apply to anybody that's an investor right now in markets. I don't know about you, Bepin. I dread this time of year. I absolutely dread it because when we wake up after Labor Day, it seems like September and actually most of October tend to be very uncomfortable. It was last year, the year before it was awful. And it's just one of those things where I just feel like it almost is like a self-fulfilling prophecy, right? You
Yep.
expect it to happen and then people freak out. It's a good example of Monday this week. Well, I'm sorry, not Monday, Tuesday of this week, the first trading day of September. Like, why? There was no news, right? The market got hammered and there was literally no news. So what we want to do today is start off our market pulse by talking about what some of the things that we feel might be causing some of the consistency in September losses. So, look, the data's the data's there, right? If you look at September and October on an average year going back to 1984, the volatility of daily returns on a monthly basis, September and October tend to be very uncomfortable. And volatility, look, we talk about this all the time. Volatility is not necessarily all bad. We have a negative connotation around volatility. If a stock is soaring to the sky really fast, it's a highly volatile stock, but that's a good source of volatility or a good type of volatility. Unfortunately, this tends to be the bad type of volatility. And if you looked at the breakdown of monthly returns over time, that will show you on the next slide on a seasonality basis. I know it's kind of hard to see the months on the screen there on the bottom on what we call the horizontal or x-axis, but it's really easy to figure out where September is. It's that bar that goes down in red. On average, the S&P 500, you tend to see about a 70 basis point or 0.7% loss in the month of September. It is not a fun month. It tends to be by far the worst month of the year. And Bepin, I know we get questions about this all the time. It's like, well, if you guys know that September is going to be bad, then why not just get out of the market before Labor Day? Like, just sell everything, right? And then just come back at sometime in early November. I think that's going to be tough because if you look at the data a little bit deeper, you're looking at almost like a coin toss. Yes, on average, it's down by 0.7%, but it's a higher only about 43% of the time, which means about 57% of the time it's down. That's flirting with a coin toss. It's really hard to make a trading strategy around something that tight. And I think if you also dig a little deeper into September, we've had a couple really bad Septembers, right? I mean, we mentioned earlier, 2022 was a bad one, right?
Yeah.
That was right after Powell opened his big mouth at Jackson Hole and scared the world. Obviously, go back to 2001, 9/11 happened, and there were some really, really extreme outliers, I think, that have kind of manipulated this data set to a certain degree to where it makes trading very difficult for consistency purposes.
One-time events, that just don't always happen. You can't really base too much of the future based off of a terrorist attack or a Jackson Hole speech.
what we call exogenous events, right? And that had nothing to do with
Mm-hmm.
markets. 9/11 had nothing to do with markets. So,
Yeah.
so then the question is, why is this happening, right? And this has been a question I think that's been out there for, I think at this point, decades. Why does September have such uh, bad performance, and even part of October? So, I mean, there's some strong theories out there. I think some of them are funnier than others. A lot of people complain it has to do with, the weather. We all
Yeah.
get out of Labor Day and we're like, okay, it's the fall. Where's the
Summer's
cool
over.
fall weather? Why are the leaves changing? And you get, I think that's part of it. I know for me personally, my kids are back in school and they're psychopaths for the first couple of weeks, which makes everybody's lives challenging in this household. Uh, I think ultimately, though, why does this happen? The idea of Occam's razor, the idea that the simplest solution tends to be the right one. So what we've done here, this is a chart that was created. Um, Basically, what we've done here is we've averaged every single day in the Dow from January 1st to December 31st, every year going back to the invention of the index, which is 100 and I don't know, 128 years, I think at this point. It's been a very long time.
Mm-hmm.
And so I guess what we're saying here is this blue line you're seeing in front of you is what an average year looks for the Dow Jones Industrial Index. Okay. Now we're hopping between the S&P 500 and Dow, but generally speaking, they tend to move in the same direction.
Yeah.
Now, the reason why we did this is we wanted to see, are there some seasonal effects that, from a data perspective, that we can assess a pattern. So the first thing I found interesting in this chart was that from that black arrow going up from June 27th to September 6th, the average return of the Dow going back since inception is about 3.76%. Now, I think that's remarkable, first, simply because that's the best time of the year. So, when people talk about summer doldrums and, there's not a lot of, trading activity, this and that, ironically, the summer tends to be the best time to own stocks.
Yeah, so
Which,
much for sell in May, right?
honestly, that's a great point. Sell and man, go away. That's what they say all the time. If you do that, you're probably, again, according to this data, you're probably not going to be very happy that you went away. But look, that red line, that red arrow rather, is kind of where we are right now. On average, from September 6th through the end of October, you're down 2.21%. This is the worst time of the year. And again, confirming some of the data we've already seen. So I think what's happening here is nothing more than profit taking. The summer's up, you made a lot of money, and getting into after Labor Day, you know what? I want to ring the register. I think that's what's happened over the years. I can't prove it. Nobody knows for sure. But when I see a chart like this, it kind of tells you that it's probably a very simple explanation.
No,
So the
exactly.
question I have for you, Bepin, is why aren't we trading on this?
Because, Mike, that's not how our models work. I know you know this, and a lot of our clients know this. We are fundamentally driven investors. We look at fundamentals, and in the stock market, the number one fundamental that drives returns are earnings per share. That is how much a company earns over the next 12 months. If you look at this chart, it shows the light blue line is showing the current or the historic earnings per share for the S&P 500. The dark blue line over here is showing the expected 12-month returns. So over the next 4 quarters here, as you can see, it goes from about 220 to 276. That's like a 25% increase over the next 12 months. This is not a market you want to sell. When the market's going to go up 25% in earnings, typically the stock market follows. It's very simple. The long-term drivers of stock market returns are stock earnings or earnings per share. And if you look at this chart here, it's showing you the historic earnings per share for the S&P 500 in the light blue line. That dark blue line is showing you the expected earnings over the next 12 months. I'm no math major, but it's showing going from $220 per share to about $275 per share. Quick math gets you 20 to 25% growth there. This is a market we're very excited about. And then when you add in the engine fuel of rates potentially getting cut here in the next few weeks, who knows how much higher these could go. Now, I'm sure they're being baked in slightly, but again, as these rates come in, exuberance about future earnings continues to go up. And the reason we don't like market timing or basing our allocation on when the calendar turns or how close are we to making a trip around the sun is because of this next chart here. This is a very busy chart. We did crop a little bit off at the bottom there to make it easier for you to see. But here, so we'll just show the bar here, or the box you're looking at is showing, if you look up, is 2005. And if you look to the left, it gives you the number 10. So that shows if you had bought into the S&P 500 in 2005 and held for 10 years, your annualized return would be 8%. Not too dang bad when you think that inflation was around 1 to 2% during this time. So about 6% of real wealth was being created any given year. And as you look, this chart gets a little bit more interesting. If you look from the right here, as of 09 and go towards the right to 2023, those returns, I mean, look at some of these, Mike. You're looking at 17%, 13%, 16%.
Those are annualized returns.
Annualized returns,
not
exactly.
just one here, one there. It's annualized. Every year you're averaging about 17%. Yeah.
And one of the more interesting parts, so that was looking to the right end of the chart. If you look toward the bottom of the chart here, what do you notice first, Mike? The one thing that jumps out to me is really the tightness of the spread. So if you look between these given years, you're looking at a range between like 10 to 6% for the most part, where if you're willing to hold for a long period of time, the range of outcomes is very tight, very narrow, and very positive for the most part.
Yeah, Bepin, that's a lot smarter than I was looking at. I just don't see any red. Yeah. Like literally no red, right? Yep. So I mean, I think it's a testament to not you just like, you know, put blinders on and own stocks for 20 years and you'll be fine. I think many people on the call today, your investment horizon is probably not 20 years for a stock portfolio, but it really is a testament to saying, look, let earnings drive stock prices, not sentiment over 3 to 6 to 7 week period.
Exactly. No, and I mean, and even looking at a longer time period, like a year or two, and this is why market timing is such a losing endeavor. I mean, you do see some red in the short term, but as you go lower here, so when you look to the left side of this chart, the y-axis, as you get down past 10, 11, there is no red to be found. So if you're willing to give time in the market, you're likely going to be a benefactor of these returns. And with that, we would like to thank you for tuning in. Again, these are going to be shorter 10 to 15-minute episodes about things going on in the market, things we're looking at, and you should expect to see these every couple of weeks. Thanks for listening, and take care.